Hi everyone, Jordan here from ASM-Trading. Thanks for tuning in back to my second installment of videos. Today we're going to be talking about Forex for Beginners, Part 1. Now, if you already have a really good understanding of what Forex is, you may want to skip this video and move on to one of my more advanced videos. This is aimed for more those people who have little knowledge to no knowledge of Forex and you're just starting your trading journey. Now, it's going to be in two parts because I remember when I first started to learn trading and Forex particularly, I watched a 2-hour long video and my brain was so frazzled I couldn't retain the information. So I'm an advocate for keeping things as basic as possible, keeping things on a need to know, and making sure that the information that you have is relevant and is going to help you moving forward. So let's first of all just cover off today's agenda then and what you're going to be getting from this video. First of all, we're going to be covering off what is Forex, because at the end of the day, if you want to know about Forex, you need to understand what it is. We're going to be covering off currency pairs, which are the things that you actually trade with in Forex. Now, you may have heard or you may not have heard of pips. It's just a unit of measurement. We're going to be covering off what they are and how you work them out in your trades. Leveraged accounts are something that you're going to have to use if you're going to be trading Forex. We'll be covering off what they are and how they work. Lots are something that is a unit that's used in Forex when you're trading. So we'll be covering off what are lots and how you work them out. We'll be covering off different market hours and different trading sessions. Types of market orders, so you understand what options you have for when you're buying and selling currency pairs. We'll be covering off spreads. If you've done like stocks trading or something like that in the past, you may understand what spreads are already, but I'll be covering that off in the video. And we'll be covering off the different types of trading now there is to do in Forex. So without further ado, what is Forex? Now, Forex actually refers to the global marketplace for trading international currencies. Forex is the largest and most liquid market in the world. And when I say liquid, there's trillions of dollars change hands every day in the market. This is why I like the market so much, because it gives so many buying and selling opportunities. Now, trading is done on what we call currency pairs. For example, the pound versus the US dollar, which we'll be covering off in the next slide. The Forex market gives traders opportunities to buy, sell currency pairs, for example, the pound versus US dollar, with the hope that when these change value, you can close the trade and profit. Just to give you a real simple example that you've probably done this before without even thinking about it. Just like when you go on holiday, if you exchange your money, it's likely to be a different value when you exchange it back. So if you ever travel to the US, or maybe if you live in Britain, you've gone to Europe and you've changed your pounds to euros, and you don't spend all the money, and when you come back, you've still got euros left. When you exchange that back, you're probably going to get a different exchange rate to what you had, because the values are changing daily. The values are changing every second, really, but we'll get onto that. All trades must be done through a broker. A broker is basically a financial services company that provides traders access to a platform for buying and selling foreign currencies. So you don't have to go down to, your local Ramsdens to do this. It's all done through a broker. And markets are open 24 hours a day, 5 days a week, excluding holidays, depending on where you are. But they are closed on the weekend. So let's talk about what are currency pairs then, because these are the things that you're going to be trading with in Forex. Now, a currency pair is a quotation of two different currencies where one is quoted against the other. Now, it consists of what we call a base pair, and it's against what we call then a quote pair. For example, GBP USD. That stands for Great British Pound versus the US dollar. And at the time of making this slide, the GBP versus USD was 1.22515. You think, what does that mean? So, to break it down, the Great British Pound, which is the base pair, is being quoted against the US dollar, which is the quote pair. And that means for one Great British Pound, you can get 1.22515 US dollars. And it's pretty simple when you just think about it like that. You need to understand there are different categories in the pairs. I don't really use the names major, minor, exotic pairs. Not many people do that much, but I just want you to understand that anything that's quoted with a USD pair is classed as a major pair. Anything with non-USD is going to be a minor pair, and you also get exotic pairs, which are like developing countries. The reason all the USD are major pairs is because the US is the biggest economy in the world, and a lot of people stick to these pairs because it's a lot easier to follow the different economical impacts that the US are having, which may impact the actual US dollar. So your broker will give you the option then to buy or sell a pair, and this is the good thing about Forex. It doesn't matter whether the pound's going up or down against the US dollar, as long as I know which way it's going. If I'm buying the pound, I want the pound value to rise, and if I close that out and it rises, then I get a profit. But if the pound's going down, you also got the option to sell, and in that case you're going to want the pound to fall in value, and then you're going to make money. So it's pretty simple. Now, we've talked about currency pairs. When you're making trades, you're going to hear a lot of people talk about pips. Now, like I said, it's just a unit of measurement. And although the first time when I seen somebody on Facebook say, "Oh, I made 50 pips on this trade," I thought, what on earth is a pip? What is that? Before I actually explain what it is, just so you've got an understanding, pip is an actual acronym for what we call percentage in point. And a pip is basically a 100th of 1%, and it appears in the 4th decimal place. So in the example there, you can see 0.001. That's going to be what the value of 1 pip is. It's just the 4th decimal place. So if you're good at maths, you're going to find this really, really easy. So the pip equals 1 basis point. Now, it's best to understand what a pip is by having a real life example. Remember we talked about USD pairs, currency pairs? So in this case, we've got USD CAD. And remember, USD in this case is going to be the base pair, and CAD, which is the Canadian dollar, is going to be the quote pair. So at the time of making this, if I was to buy USD CAD, the price would have been 1.34682. So I can get 1.34682 Canadian dollars for $1 US. Now, if the US dollar rose in value and I closed the trade at 1.35201, what was the gain in pips? So have a think. How do you think you would work that out? Well, when we work out the difference, it's really simple. It's really simple maths. You just take the largest value, which in this case was what we finished on, 1.35201. We minus that from the initial value of 1.34682, and that equals us 0.00519. Now, looking at the 4th decimal place is 1 pip. When you're working this out, 1, 2, 3, 4, how many pips do you think that this is? You probably got it already. But it's actually, at face value, 51 pips. Because you just look at 1, 2, 3, 4. So this is obviously 1 pip, and this is 50 pips. 51 pips. If you want to be a bit more specific with your math and you want to round up to 9, because a lot of the quotes do have 5 decimal places, you could round that up to 52 pips if you want to be specific. Now, this is the case with all pairs, apart from JPY pairs. Now, JPY stands for Japanese yen. So the way we worked out the pips initially will apply to everything that doesn't have a Japanese yen. I don't know why. The first time I seen this, I was like, why have they got to be awkward? Why does a Japanese yen have to have a different way of working out pips? But remember, that's the case with everything except for these. So the reason why is a Japanese yen pair is quoted with 2 decimal places instead of 4. Now, it's exactly the same sort of thinking that we were doing before, except each pip is the value of 0.01. So rather than working out 4 decimal places, we now just got to work out 2. And it's exactly the same maths otherwise. So let's just have an example though. At the time of writing this, if we were to sell, and we'll have a sell example now so we can see the difference between the two. Euro JPY, which is obviously the euro versus the Japanese yen. The euro being, remember, the base pair, and the Japanese yen being the quote pair. The time when I made this slide, the euro JPY was 141.694, which means you can get 141.694 Japanese yen for 1 euro. And we sell that, so we're going to want the price to go down. And if in this case it did, and the price went down to 141.076 when we closed the trade, what was the gain in pips? How are we going to work that out? So again, just take the larger value, in this case was the starting value 141.694, minus that by the 141.076 equals 0.618. I know I'm saying a lot of numbers, so I hope you're still with me here, but it is pretty straightforward maths when you think about it. So looking back up here, if each pip is the value of 0.01 and it's every second decimal place, what's it going to be here? So we got 0.61. Simple, 61 pips on face value. But if you wanted to be specific and round it up, then, which I always personally do, I'd be rounding that up to 62 pips. I hope that makes sense. When we go on to further videos where we're actually taking trades and we're working out what the pips are, it'll make a lot more sense. But if you ever need to revisit, just come back. But hopefully that explains what pips are for you. So the next thing we'll talk about then is what is a leveraged account. So using a leveraged account means using borrowed capital as a funding source to increase funds. You will usually be given a choice of how much leverage you want on an account. So somebody might give you a leverage of 1 to 10. Me personally, I go for the highest leverage possible, which is 1 to 500. And so basically what that means, so if you opened a 1 to 500 account like I've done and you deposit £100, you can actually trade with volumes of up to £50,000. Sounds a bit daunting, but I promise you with proper risk management you're absolutely fine. So this can amplify returns, but also can amplify your losses. Like I said, I've seen people not use proper risk management and blow their account in one day. This is why risk management is paramount. But I'll be teaching you all of the steps later on down the line, how you can manage your risk so that you're never going to lose more than you set out. So if you only want to risk £10 in a trade, that's the maximum you will actually lose in that trade. The thing is with Forex is leverage account is required for Forex trading. So you're going to have to learn to deal with what these leverage accounts are and how they work if you want to trade Forex. And it's what you need to know, and what probably going to see when you first make your demo account, and it's going to be a leverage account. You're going to see your equity and your balance, which is your balance is just what's in there and what you've deposited. Your equity is what your balance is with any open trades. Then you're going to see something called a margin. The first time I seen a margin, I thought, what on earth is a margin? So the margin is just the amount of equity you need in your account to keep trading. So it will say to you, your current margin is 200, which means you need at least 200 pounds in there to keep trading, or they'll give you a margin percent, sorry. So if your margin gets to 0, then the chances are your trades are going to be closed and you won't have enough equity left in there to trade. This will make a lot more sense when we go on to setting up your account for the first time, and I talk you through those steps, and you start making trades. It'll all start clicking into place. But just remember, risk management is always paramount, because you are going to be trading with larger volumes than what you've actually got on your account. So those gains can amplify. We talk about leverage accounts, pips, currency pairs. Next thing is, what is a lot? So a lot on Forex is just a unit of measurement. When you first open up your demo account, we talked it's going to be a leveraged account. You're going to see you want to buy the Great British Pound US dollar, and it's going to give you the option in lots. You're going to think, what on earth does that mean? Well, hopefully this will explain it for you. So first of all, you need to understand lots are split into 4 categories. One standard lot equals 100,000 units. A mini lot equals 10,000 units. One micro lot equals 1,000 units, and one nano lot equals 100 units. However, most brokers, and I've only ever used the brokers that deal with standard lots, you can get lots which are, like I said, you get micro lots or nano lots, which means you're going to be trading with a lot less money. I think people call them cent accounts, where you're trading with pennies at a time rather than with the actual standard lots. The standard lots are the way to go for me. So probably sounds really confusing. You're going to want to know what does this all mean. So let's just have an example with a standard lot. So if you use a standard lot size account and you place a trade of 1 lot, what's that going to mean? Well, because 1 lot equals 100,000 units, each pip movement would actually equate to £10. That's quite a lot. Think about when we did a small move and it was 61 pips. Well, if you did a one lot on that, then that's going to be £61. And whilst this is confusing, and you may think, God, I can't work that out every trade. Don't worry about it. There are what we call risk size position calculators that are free, and they will work out how many lots you need per trade. So let's say, for instance, you want to buy the pound versus US dollar. You know where your stop loss is going to be, which means you know where it's going to stop you out if it goes against you, and you know it's going to move 25 pips, and that's your max, and you only want to risk £10, say, on that trade. You put these details into a risk size calculator, which we'll cover off in the second video, in part 2, and it will say to you, for you to risk £10 with a trade you want to take, use 0.02 lots. So with confidence then, you can enter a trade for 0.02 lots, and you know you're not going to over leverage yourself, and you know you're not going to lose too much money. This is what I talk about when people don't have, in my first video, when they have the lack of knowledge. It's so easy to blow an account, because if you just went and placed a one lot on something which you didn't know what you're doing, you've only got £200 in there, that could be gone within a matter of seconds. The next one I want to talk about market hours then. So as I mentioned earlier on in the video, the Forex market is open 24 hours a day, Monday to Friday. But you do need to understand that the days are actually split up between different trading sessions. Now, these trading sessions split between the following, and I'm using UK GMT time now, and you can see I've got a little bit of an example here on the right. Sydney session is open from 9 AM till 6 AM. Tokyo is open from 11 AM till 8 AM. London session 8 AM till 5 PM. If you're in Britain, this is obviously in Britain. And New York session is 1 PM till 10 PM. So you understand, well, why do we need to know that? If I know that the market's open 24 hours a day, Monday to Friday, is that all I need to know? Well, what you need to understand is during the day, the volume of trading will increase and decrease really drastically. Generally, you can find trends, and these can be identified between the different trading sessions, and you can find a time that suits your trading style best. So for me personally, I like to trade between the London and New York session. So if you look on the right here, this is out by an hour compared to what I just showed, but we have an overlap from where the London session opens and where the New York session opens. So we've got 5 hours of trading, 1, 2, 3, 4, 5, where London and New York sessions, where generally most of the trading is done in the market. So you have high volatility at these times, and it just presents you lots of opportunities, because when the price is moving, that's when you're going to get opportunities to buy or sell and make money. And you're going to see then trades are going to really die off towards the end of the night, and then the Sydney session is going to pick up from 10. 10 is really quiet, but then when Tokyo session kicks in from 11, you've got these two running the same time overnight. I find nothing usually drastic happens overnight usually. Not saying it never does, but usually it doesn't. But this will pick up the trading volume throughout the night then. So if you are a night owl, you want to do some late night trading, you might find that your trading style will work best during the Tokyo session. Like I said, the time usually gives the greatest volume and presents most opportunities between the London and the New York. So I hope that makes sense and why. And when we go on to our different strategies, we'll maybe cover this off in a bit more detail of how I take these into consideration when I place my trades. The next one we'll talk about are the different types of market orders. So it's important to know that there are multiple market orders as shown on the right here. So this is a screenshot that I've taken from my phone of what we call MetaTrader. It's one of the main applications people use. Doesn't matter what broker you are, everyone runs it through MetaTrader. And you can see there, when I've dropped down on market execution, it's give you the option. So market execution then basically is if you want to place a trade right away. If like right now you want to get in the trade and you think I want to buy, in this example, pound versus US dollar, I want to buy it right now, then you place a market execution, click buy, and it will execute it right away. Limit orders, which you can see here, we have a buy limit and a sell limit, allows traders to set a better entry price. So just to give you an example, if we believe the pound was going to drop before rallying higher, you could place a limit order to get a better price. So if you knew that the pound was going to drop further and you think, if I buy in here, then I might not make as much profit, you can set it up on here. You place a buy limit and you place the price that you want the order to take place. You place your stop loss and you take profit, and as long as the price makes it, your broker will automatically place it for you. So it's a really good way of maybe making extra money, or maybe rather than looking at the chart and waiting for a better price, then you can do that, and if it gets there when you're not looking, it'll automatically happen for you. On the contrary, stop orders can be used to trade breakouts. Now, to give you an example, if you thought that the pound was going to continue rallying, if it broke a certain level, you could place a stop order to catch the breakout. So we got here, buy stop and sell stop. I don't really want you to understand right now what a breakout is, and we're going to cover that in later videos, but generally in trading, there'll be a certain price that if the price breaks above, it's likely going to continue, and I'll explain that a bit more later on. But this is where we can use the buy or sell stops. So all orders come with the option of a stop loss and take profit to manage risk accordingly. A stop loss basically just means if the trade goes against you by this amount, you want to cut the trade out, so you limit your losses. And a take profit means if it gets to this certain point, I want you to take my money and run. So like I said, when we start placing these orders, when we start going through some of the strategies, it's going to make a lot of sense. Spreads. So I told you we talk about spreads. If you've done maybe other types of trading, you may already know what these are. But the spread is basically just the difference between the broker's sell and buy rate when trading. And you can see I've put another example here on the right. Spreads can vary depending on the currency, time of day, economic conditions. What's good to understand is brokers can widen the bid-ask spread, which is the difference between the spread, meaning you could be paying more per trade. So it's easier if we look at this as an example now. As an example on the right then, the Great British Pound versus US dollar. If you were to buy Great British Pound versus US dollar right now, how much you're going to be buying it for? So you can see we've got the buy here, and we're going to be buying it for 1.22213. And then imagine we entered that buy and then we sold it immediately before the price had any chance to change or decrease or increase in value. Then you're going to sell the price for the sell ask here of 1.22187. So let's just go back and think about when we were talking about our pips. How much you're going to lose out on that trade by just because of the spread. Not because it's changed in value, but just from buying and selling straight away. So you take the larger value, 1.22213, minus that by the lower, 1.22187, and you're going to be losing out on 2 pips, or if you want to round it up, 3 pips. So this trade would end in a negative 2 pips immediately without the price actually changing. Now, if you're trading higher volumes and using really big lot sizes, so think back when we talked about the lots, we worked out that one lot could equal £10 per pip, and on this case you would have lost about at least £20 on a trade just from the spread itself. So you need to take this into consideration. It is to know though, some brokers offer better spreads than others, and when it gets more so when there's less trading volume, the spreads do tend to increase. So usually when those markets are changing over in the night, you see that the spreads widen, so you have to just be careful a little bit. They make sure they don't stop you out or anything. Okay then, let's talk about the different types of trading then. So whilst there are thousands of different trading strategies, just really basically and categorically, these could be split into 2 main types of trading. You've got something called technical analysis. So this is just being able to analyze the charts and patterns to recognize buying opportunities. And this can be used on its own. I know people who just use technical analysis, and this arguably could be seen as the most important part of trading. Now, I use this personally in every single one of my setups, and when I talk you through my different strategies and how I make money in the markets, this will be the main thing that we do to be able to profit from the market. It's just learning different price patterns and using different indicators to give you the best chance of knowing what the price is going to do next. And when you first start learning technical analysis, you think, wow, I can't believe I didn't know this before. But the second thing that you take consideration when trading is fundamental analysis. Now, arguably it's hard to see how somebody can make money on just fundamental analysis, especially in Forex. Maybe more so if you're looking at the fundamentals of a business and looking at stocks, that could be different. But like I said, the Forex market is so volatile, it's hard to base your whole strategy based on fundamental. But you need to understand that the country's economy is depends what it's doing is going to impact the currency in different ways. I will be covering this off and the both different types of trading in my future videos, but just on the fundamental analysis, just for instance, when a bank may increase do a rate hike on their interest rates, and when that generally happens, that usually strengthens the currency that it's with. So when the US dollar have been announcing big interest rate hikes, that's been making the dollar go rise in value, and so things like the Great British Pound versus US dollar is going to drop, and you usually find that when these news announcements are made, the highest volatility from those announcements will come right just as they're happening. And when we cover these off and we talk about the different types of trading and my different strategies, I'll actually do a whole section on the fundamental part and how the news will impact your trading as well. So that's covered most things off for part one. So just to recap, we covered off what is Forex fundamentally and the basics of what it actually is, currency pairs and pips. We know what currency pairs are now, and we can work out the pips or when they change in price. We had a brief overview of leveraged accounts. We talked about what are lots really briefly. We talked about the different market hours, types of market orders, what are the spreads when trading, and the different types of trading. So again, thank you for tuning in for part one. If you tune in next for part two, we'll actually be looking at the different type of market structures, maybe looking at charts for the first time, and how you will look to use different areas of value to start placing trades in the most basic format. But until then, if you liked the video, drop a comment, or if you've got any questions, feel free to drop me a message. Take care, everybody.